Okay, so let's have a look where what kind of numbers I put. I put 127, 130. So this is range. Now, when you look at the company like that, it seems like $3. Oh my goodness, it's huge, a big difference. But in reality, if you look at the price, imagine like if they decide to split the share, they split the share and make it 10 times. And instead of $127, it's going to be $12.70 or $13. Is it a big difference between $12.70 and $13? Not as huge already, right? It's not $3. It depends how many shares you buy. It depends how much money you invest. But then if you look for like $28 or $180 move, so it's like from $13 to $18, or from $12.70 to $18. It's not a huge difference. So that's why you have to be kind of considering the situation, the opportunity cost, the upside potential, and your risks. Always consider risk. So yes, it can go down. Based on fundamentals, it's practically no reason to go down based on fundamentals. But remember that we live in an emotional world, and people make their investment decision based on the news, not on fundamental information. So of course the company can go and low down, and in this case you always have to consider maybe to buy more. Okay, if the company drops down more, so you buy it more, and then you'll make the most amount of money. So so if you're long-term buy and hold investor, okay, and you don't spend in the market a lot of times, so what you do, you buy it at these levels and hold until 300 bucks. Okay, that's it. It might take 2-3 years to get there, maybe 4 years to get there, but it's more than 100% so 130% plus dividends. Why do we get this number? Where I get this number, 308%, based on value line analytics and hours. So we identified that the highest hold price about 308 bucks. So it can go there. And also if we look at value line sees it between 280, 375. So they're a bit different numbers with others, but 300, it's kind of in between for both our approaches. So in this particular case, so definitely can buy and hold it. Forget about this company, like put some kind of amount of money, $10,000, diversify your portfolio if you have $100,000 portfolio, and keep this company for quite a lot. Now, for guys who are more active on the market, and I can see that majority of you are, because based on your entry and exit point, so you just buy around 127.30 and sell it. And you can sell it like based on technicals. It's based on where you identify this exit point. So you can sell it in this level. So it would be about 141 or 144 here, or you can go to 160, or you can go 150, something like 4 here, I think. So based on that, you can keep an eye on that. And as soon as it stops at certain resistance level, on new level, start turning around. Remember, all these kind of indicators going to be here. That's where you sell. You can use what? Trailing stop. You buy it, and then when it goes up, 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 you don't sell as soon as it's turned around, start going down, trailing stop triggers, and you exit the position. So definitely, it could be any of these ideas. Now, if you buy in shares, now, if you decided to buy and use options, this is a different story. So again, you need to identify your ideal profitability level and then to decide what to do. Are you going to sell naked puts, or are you going to buy shares and sell a call, or you're going to just buy lip call? What are you going to do? Because the risk profile increases, right? So if you buy lip call, so you can lose 100%, but you can make 100%. Okay, so if you sell covered call, your risk profile is nearly the same as naked puts. Then on the top, you are getting some dividends. Okay, but again, so your capital is high in this particular case, allocated, or you can sell naked puts. So what would you prefer? We have to distinguish based on what? We have to look at options. Okay, and who wrote? Dmitry, yes, so wrote that he's going to buy options, or whoever. I missed it. Okay, so let's have a look. So at option chain and see what can we do. Now we can sell covered call and we can sell naked put. Now the good thing about MCK, they have weekly options. So you can sell it for 10 days, you can sell for 70 days, for 24. You actually can sell until this Friday. I just didn't show it here because it just wasn't fitting into here. But you can have a look at your trading platform and 1 month. So it's 31 days. Okay. If we're selling covered call, the current price is $130. Now again, guys, we're going to make our calculations based on current market price. Remember, as soon as price changes, so for example, if the price goes to $120 Solent, the price of the options will be changed as well. But we're going just in order to, like an example, we're going to identify how much we're going to generate by using these strategies. Okay, so now if we decide to buy a share right now at $130, what strike price you're going to use to sell a call and what duration are you going to use? Guys, your ideas. So let me know. Like, it's not the same. You might not do it, but if you decided to do it, so what would be your option? Or we just can take it as an example just to calculate. $130 until September 21. Okay, perfect. Let's have a look at this. $130 until September 21st. So it's this one. So how much we're going to get? Are we going to get 370 or 340? 340, correct. Okay, in this particular case, if you do this strategy, so you pay $130.65, and you're going to sell it for 130. So you're going to lose 65 cents on a sell, correct? So your net profit would be $3.40 minus 65 cents. $3.40 minus 65 cents. So it would be $22.75, correct? So $2.75. And if the share ends up above this price, your shares are going to be taken from you and you're going to make $2.75 on that share. $2.75 divided by our investment of 100, would say $30, it gives us 2.1% return on investment. That's for 30 days. So if you do this strategy for 12 months, it gives you 25% return annually. Okay, if you're going to do $31, so in this case, you're going to collect $2.9. So in the case if the share price stays below 131, you're going to do 2.9 divided by our investment $130.65. It would be 2.2%. So in cash. But if the share price goes up, you're making 45 cents on the top of that. Okay, 35 cents, sorry, 35 cents. So it would be $3.25 total profit. $3.25 divided by $130.65. It would be $2.4, nearly $2.5. So you have an option here to make $2.2 if the share staying below $131 and $2.4 if it goes above. So nearly the same. Okay, that's what you can do. Now it's called, if the share price goes to $141 or whatever we identify there, you are not going to make this $10. Your profit is limited. But at the same time, if the share price stays below that level, your break-even point where it's going to be. So if you're going to sell for 0.9, you bought it at 113.65 and you collected 2.9. Where's your break-even now? Correct. So and where it's going to be? So it's $127.75. Correct? So that's practically the place where we identify this kind of situation where it can have a pullback. Of course, it can go even lower, but that's the resistance which we had a couple of days ago. Okay. Now, if we decide to sell put, how much money we're going to make from put? So let's guys again. So what strike price and what duration we're going to choose? So any ideas? Andrei is most active. What about the other guys? Okay, and good. Okay, 130 for September 21st. Okay, 130. So we're going to get how much? 28 or 295? How much we're going to receive if we're selling put? Negotiate, correct. So we can negotiate. We receive 290. But if we keep on that one, so how much we're going to get? 280, correct. So 280 we're getting, and if the share price drops down, so we promised to buy at 130. If the share price stays above $130, we don't have to buy because we promised to buy at 130. Nobody is going to sell us at 130. But if the share price drops below, our average price would be where? 127.20, correct? So again, we are going to be on this specific level somewhere here. Our purchase price will be like, yes, of course, it can drop even lower, but that's where we're reducing our price down. So we're buying kind of cheaper in this specific case share. Okay. Now, if the share moves all the way up, how much we're going to make? What's the return? 2.8 divided by 130, because that's our capital which we allocate. We have to keep this amount of money. So it's about 2.2%, 2.1%. Correct. Again, if you multiply it by 12 months, and if you do it on a monthly basis, it gives you nearly 25% return annually, even if we don't take into consideration compounding interest. Okay, so we got it. Now, if you're going to be more aggressive with the McKesson Corporation, what strike price will you choose? $132, so it's $2 or higher. I'll tell you, when the share price dropped to $144 here, I sold $1.50. At that time, I sold it for $9. Maybe even lower it was. I got $9. So I sold nearly $7 above because the volatility is quite high here. So it can. That's why right now I chose buy shares, not sell puts, because what happens that I can have from 123 to 144, so I will have nearly 20, like I mean, what, 21, $22 move. I cannot get it from put options. Okay, so that's why every time you have to consider what to do, where's your decision to be made. Okay, so another one is buy and put option, or buy and call option. So that's what one of you, I forgot the name, like who did it. But okay, again, so we have McKinsey for January 2018. We have until February 2019, sorry, not 18, 19. So it's 5 months, 6 months, and 1.5 years. Which one we're going to choose? Which strike price we're going to choose? Okay, guys, remember, that's a buy and leap call. So if we buy for longer term. We don't buy short calls because we have time until it moves. This move happens. Okay, so any suggestions? Who was going to buy it? Dmitry, I think. 140, yeah, Dmitry, I think you said. 150, February 15th, okay. 150, February 15th. Okay, Nona, 140, 2012. Okay, so that's nearly 10% for this specific. Okay, and anyone else? Someone was putting 140 before as well. Didn't sell the duration. I think it was Dmitry, right? Okay, let's have a look. So let's calculate I don't know what we do. Nona was first, so we'll calculate her profitability. Now, $140, that's your strike price. Very important to know when you are planning to exit. Nona, at what level you are planning to exit? So the question is, if you are buying something, right? So for example, doesn't really matter share or you buy an option, you have to know your entry. So if you entry now, your strike price is 140, but where's your exit level? So when you're going to exit this position? $150. Okay, so you're allowing $20 growth, and then you're going to exit this position. Perfect. So let's have a look and see what we have there. So from at the moment price is 130. No, it's a strike price 140. The strike, so she agreeing, just she buys the call option with strike price, but the current price is 130 still. We just expect that the growth because we need to different strike. Yes, correct. Now let's have a look. So we're taking Nona takes this February, so we take 140. So we pay $14.30. Let's calculate it like that. Okay, just a second, guys. Show whiteboard. So that's $14.30, right? Correct? That's what we pay. Now, pay attention to the difference. What's the spread here? Just remember, 50 cents. Correct? Now, another thing which we need to distinguish, okay, the price of the stock is going to move for $20. How much is going to move the price of our option? How do we calculate it? Delta, correct. So we look at delta. Delta right now at $140 is 45 cents, 49 cents. Now the thing is here that 49 cents is valid only for next dollar. So if the share price moves from 130 to 131, that would be 49 cents. As soon as the share price start moving up, the delta will grow up as well. Because the move was very big, we have to take it into consideration. If the move was $1, $2, $3, you might leave it like that. Okay, you calculate it. But because the move was $20, it's quite a huge move. You have to take into account how delta is going to be changed. Now, I'm not going to involve like how it's going to change delta based on other Greeks. The simple way to do it, okay, fine. If the share price moves for $10, so the delta will be roughly like it is now at $130. So like, because if we move, the share price moves $10, it would be at 140. The delta is going to be something like that. So it's 0.57, okay, 58 cents. Now, if then the share price moves another $10, the delta is going to be similar to like 120. Now, we don't have 120 now, as an example, but it's going to be around 170 or 70 cents, roughly 70 cents. So we can assume that delta within this $20 move is going to fluctuate between 49 cents until 70 cents. So can we take somewhere in the middle? For example, we can take this 57 cents. So instead of multiplying by 0.06, okay, aggressive, or 55 cents, whatever you decide. So you can play around with those numbers because if the volatility earnings are going to earnings are going to be 10th of October, so in the end of September volatility will increase and probably you will get much more money even if the share price is going to stay the same. Okay, but in any way, so let's have a look at this one. So 1.057 cents. So whatever is now, so it's like an average. Okay, we assume that it's the average. Again, you have to check 120, but we're assuming it's 157. So in this particular case, we know that that's the price which we paid, $14. Oops. $14.50, and then we multiply $20 move, multiply by 0.57, and that's equal 11.4, right? Andrei, I presume you calculated that. Okay, cool. So 11.40. So we know that the price of this option is going to move to $11.40. Now, what was the spread between buy and sell? We always have to consider this buy and sell difference. So how much it was there? 50 cents. So we have to deduct this 50 cents. So in this case, our probable option price move is going to be $11.9. Okay, $11.9 divided by our investment of $14.30. How much is that? Andrei, did you calculate it already? 100, no. Sorry, 10.9, correct. 10.9 divided by 14.3. Who calculated it already, guys? 76%. 0.2%. So that's kind of move you can get if you buy call and wait until it goes to $160 or $150. Okay. Do you want to calculate another situation? February, for example, 140, what Dmitry wrote. Do you want to calculate just in order to understand how it works? Okay, let's have a look. 140. Okay, it's $10. It's easier to calculate. And the only difference, Dmitry, where are you going to exit? What level? 150. Also 150. Again, $20 move. All right, fine. So in this particular case, we're buying at $6.10. What's the spread here? 60 cents. Okay, we're losing 60 cents. Now, we have to consider the delta in a similar way. So let's have a look at average, which is right now for 130. Okay, so at the same level. So what is delta? We're assuming that right now for $1.40 is 38 cents, like 0.38. At 130 is 55. I presume at 120 is going to be about like 60 something, 62 or 0.62. So let's take again 0.55 as average. Okay, just assuming that 0.55. Okay, $20 more. So what do we do here? So we invest, how much money we invested? 6.1. So our invested money is $6.1. Okay, again, $20 move. Multiply them by 0.55. How much is that? $11. Yeah, correct. $11. Could calculate it myself. $11 minus 0.60 spread. So which gives us $10.40 profit. Okay, $10.40 we divided $10.40 divided by our investment $6.10. How much is that? 170%. So very big difference, 100% nearly difference. Why do you think this difference is so huge? Why? Correct, Andrei. Risk is higher because we don't have that 1 year. We have only until February. And the price of the option is much, much lower. Whereas in another case, we're taking extra 1 year for this specific situation. If you go for January, it's going to be even more profitable. Look, 140 is $4.70 and here $6. So if you go for that specific date, and assuming that your delta is about the same, 55 cents, so how much money you're going to make? So instead of $6, take it now $4. How much is there? $4.70 minus $4.70 minus 20 cents. Like, so how much is that? So divide by 470 here, because the profitability would be exactly the same if it happens very quickly. But divide by $4.70, 212%. Okay, but remember, with options, you have all this risk of losing all your money. So that's why never, ever put all your money in this trade. When you're choosing options, you have to, especially this type of strategy, never put more than 5% of your income. So for example, you generated some cash from selling puts or from selling covered calls or made money in another way, and then use that profit in order to do options. Okay, I know that sometimes it's very tempting to do that, but that's how people will lose money. It's if you like 99% of the time you're right and you're correct and you're like doubling your money, and then one time you put all the money and you were wrong, you're going to lose and start from the very beginning. So that's why never ever let yourself to use this strategy all the time. So first of all, if you diversified your portfolio for different companies, so it's if you're using 5%, don't use 5% only for one company. Like try at least to have 2 or 3 option companies, like, I mean, and then you have shares, pure shares, where you know that they're going to grow in any way. So, okay, guys, please put that you understand that, because I know, I remember myself when I started, it was really, really tempting to do that. And of course, remember that it's like, before you place any trade, you have to fully understand all possible outcomes of that. Because, like, I mean, we're all positive. I know you guys. And when I place my trade and if I buy something, I'm sure that it's going to go up. Like, that's why I do it. But believe me, like, something can happen. Interactive brokers, Hannah, you can look at interactive brokers. I'm looking always at my broker. That would be Charles Schwab's, because I have an account with them as well. But you can look at interactive brokers, or you can look at Yahoo Finance, NASDAQ. So quite a lot of. In our program, I was showing which websites you can use. Yahoo Finance, MSN Money, NASDAQ, but the best thing is to use your own broker. Okay, guys, is it all clear? Now the question is for you. So if we're all together now to look through all these different strategies, what kind of strategy do you think you're going to use? You don't want to do anything with this company, or you're planning maybe to buy option or sell put or buy shares and sell shares. What's your plan? Do you have any idea, at least what you're considering right now after going through this masterclass? Okay, Dory, stocks, naked puts, options, stocks, sell naked puts. Okay, guys, excellent, excellent, good. Okay, fantastic. Yeah. Okay, in any way, so great. We're going to meet next week, so you can share already what happened with your portfolio. What did you do in this particular case? We can discuss. I missed where is the cash flow for the company. Okay, so I'll have a look now. Okay, good question. So the cash flow you see here, it's the second line. So sales, then cash flow, then earnings. So, and we can see that if earnings were $12, cash flow was $17. So $5 higher, like 1.5 times higher. Now, when it happens, usually it happens when the company has some kind of expenses which are not real expense, not cash expenses. For example, depreciation, or when company is writing off goodwill. And believe me, MCK has a lot of goodwill, because look, right now here it has says book value is $48. In reality, it's minus 25. Tangible book value is minus 25. So the company has no, like, I mean, it has tangible assets, but because it has that, I mean, if you deduct tangible assets, tangible assets deduct intangible assets, eventually you'll be negative in book value. But remember, they have a lot of patents, they have a lot of rights, and because they were buying other companies, they have goodwill as well. So, and that's why when I considering here, I put here that earnings 25th of October and tangible book value minus $25.8. So that's one of the things which you have to consider. But you worry about this number when you think that company is going to get bankrupt. So I don't believe that the MCK is going to get into bankruptcy during nearest futures. Okay, Hannah, did I answer your question?